This could be huge for Fluor Corporation. Ticker FLR is trading at an incredibly low trailing PE of around 4.8 times earnings. That's almost unheard of for a healthy Fortune 500 company with a $6.8 billion market cap. Here's why this engineering giant might be massively undervalued right now. First, Fluor has a major stake in NuScale Power, which just achieved a massive milestone in May 2025. NuScale became the only small modular reactor company with 2 approved designs from the U.S. Nuclear Regulatory Commission, including their 77-megawatt design that was just approved ahead of schedule. With data centers needing 90,000 megawatts of new power by 2030, Fluor is positioned perfectly for this nuclear renaissance. Second, they have completely transformed their risk profile. About 80% of their $28.2 billion backlog is now under reimbursable contracts instead of those risky fixed-price deals that burned them before. This means more predictable margins and way less execution risk going forward. Third, the data center boom is massive for them. They have already signed master agreements with major tech providers and completed innovative colocation data centers in India. Revenue hit $16.3 billion in 2024, and despite recent headwinds, their long-term positioning in this growth market remains strong. Fourth, they generated $653 million in operating cash flow over the trailing 12 months, and $5.5 billion in cash with only $1.1 billion in debt, giving them a net cash position of $1.4 billion. That's incredible financial flexibility for an EPC company. Fifth, that ridiculously low pay ratio tells the whole story. At under 5 times trailing earnings, the market is pricing in permanent problems. But if their strategic transformation works, this could be the bargain of the decade. Even modest multiple expansion could drive massive returns. Now, full transparency, there is one major red flag that just happened. Their Q2 2025 earnings were brutal. They missed revenue estimates by over 17% and earnings by 27%. Management slashed full-year guidance significantly, and operating cash flow actually turned negative at minus $21 million. This company has a long history of execution problems, and that recent stumble raises serious questions about whether they have really fixed their operational issues. What do you think? Are you bullish or bearish on FLR? Does that ultra-low pay ratio scream opportunity or value trap? Drop your thoughts in the comments and smash that like button if this helped you.